Every major market crash in the last 100 years followed a specific 6-month pattern before it happened. 6 months of warning signs, building one on top of the other before the collapse. We are currently at month 3. In this video, I'm going to show you exactly what happened in months 1 and 2, what month 3 looks like historically, and what months 4, 5, and 6 have meant for every crash since 1929. Value proposition. By the end of this video, you will understand the 6-month crash timeline, where we are inside it right now, and what the historical pattern says happens next. The 6-month pattern. Explained every major crash, 1929, 1987, 2000, 2008, followed the same general 6-month structure before the collapse hit. It is not a coincidence. It reflects how leveraged financial systems unwind. They do not collapse instantly. They collapse in stages. Here is what each month looks like. Month 1 is when the first cracks appear. Credit starts tightening. A bank reports unusual losses. A major hedge fund quietly reduces exposure. Most people miss it entirely because the market is still near highs. Month 2 is when institutional investors start distributing. They sell slowly into rallies. Volume picks up on down days. The market makes a new high but barely holds it. Month 3, where we are now, is when the pattern becomes visible to anyone paying attention. Market breadth deteriorates. Fewer stocks are participating in rallies. The index holds up, but only because a handful of large stocks are carrying it. Warning indicators start flashing. Month 4 is when the first public panic event happens. Not the crash itself, a warning event. Think Bear Stearns in March 2008, 8 months before Lehman. A visible crack that the media says is contained. Month 5 is the false recovery. The market rallies after the month 4 scare. Everyone says the worst is over. Retail investors buy back in. Smart money uses that rally to finish exiting. Month 6 is when the cascade begins. Where we are at month 3. So where does early 2026 fit into this timeline? Month 1 maps to approximately May and June of 2025. Regional bank stress became visible. Credit card delinquency rates hit multi-year highs. Commercial real estate loan problems started surfacing in bank earnings reports. Most people ignored it. Month 2 maps to August through October 2025. Institutional fund flows shifted. Hedge fund net long positions dropped to their lowest level since 2020. Corporate insiders were selling at near record pace. The market was still close to highs. Month 3 is right now, January and February 2026. Look at what is happening. Market breadth is at its weakest point in 2 years. The so-called Magnificent 7 tech stocks are carrying the entire S&P 500, while most other stocks are flat or declining. The inverted yield curve has re-triggered. Credit spreads are widening. 4 out of 5 major crash indicators are flashing red simultaneously. This is textbook month 3 behavior. What history says happens in months 4, 5, and 6. Now here is the part that matters most. In 1929, month 4 brought the first visible market break in September. Month 5 was the October 11th rally that fooled retail investors into thinking the worst was over. Month 6 was Black Tuesday, October 29th, the crash. In 2008, month 4 was the Bear Stearns collapse in March. Month 5 was the summer rally through July, where the market recovered, and analysts declared the crisis contained. Month 6 was September, Lehman Brothers, AIG, the full collapse. In 2000, month 4 was the April tech sell-off. Month 5 was the summer bounce. Month 6 was the September-October collapse that began the dot-com crash. The pattern is not identical every time. The timing shifts by weeks. But the structure, crack, distribution, breadth deterioration, panic event, false recovery, cascade, has appeared before every major crash in modern history. And if month 3 is now, month 4 is coming in the next 6 to 10 weeks. What month 4 looks like. You need to know what to watch for. Month 4 is not the crash. Month 4 is the warning event that most people will dismiss as contained. Watch for one of these: a major regional bank reporting emergency losses, a large hedge fund gating redemptions, a sudden spike in credit spreads above 150 basis points, or a single-day market drop of 4% or more that recovers quickly. When you see that event, the pattern says month 5 follows, a recovery that pulls retail investors back in, and then month 6. The question is not whether month 4 is coming. The question is what form it takes and whether you recognize it when it arrives. Disclaimer. This is educational analysis of historical market patterns, not financial advice. The 6-month crash pattern has appeared before every major collapse since 1929. We are at month 3. History says months 4, 5, and 6 follow. If you want updates as this pattern develops, subscribe. Are we at month 3, or do you think this cycle is different? Check the video on screen about the 2008 pattern. It maps directly onto what month 4 looked like before the last major crash. See you in the next one.